You ever wish you could just read the market's mind? Like get a single number that tells you if everyone's feeling greedy or if fear is starting to creep in. Well, turns out there's a way to do exactly that. Let's get into it.
I mean, what if you could actually measure that gut feeling, See the storm clouds gathering before a single drop of rain falls.
The pros have been doing this for decades. They've got this tool, kind of like a financial pulse monitor, that lets them gauge the whole mood of the market.
And that tool, it's called the VIX. Officially, it's the CBOE Volatility Index, but pretty much everyone just calls it by its nickname, which honestly is way more descriptive, the Fear Index.
Okay, so how does this fear index actually do its thing? Well, it all boils down to this fundamental relationship it has with the stock market. Think of it like a seesaw. It's a really crucial concept to get.
So here's the deal. The VIX isn't looking backwards at what happened. It's a forward-looking thing. It's basically calculating the expected chaos or volatility for the next 30 days. And it does this by looking at option prices on the S&P 500, which you probably know by the ticker SPY. So in short, it's the market's own prediction of how bumpy the ride is going to get.
And this is that seesaw in action, right here. When the VIX starts climbing, it means traders are getting nervous, they're buying up protection because they expect turbulence. And that rising fear? It almost always happens at the same time the S&P 500, or SPY, is heading down. And the reverse is true. When the market's chill and climbing, the VIX drops. It's that simple. One goes up, the other goes down.
But, and this is where it gets really interesting, the pros don't just glance at today's VIX number. Nope, they study its behavior. They're looking for specific patterns over time that can give them a heads up about what might be coming down the pike.
So this table kind of breaks down what they're looking for. A sudden, sharp spike in the VIX, that's panic, a risk-off moment. The VIX getting super low and compressed, that's complacency. Everyone's feeling a little too comfortable. But the one we really need to pay attention to is divergence, because that is often the big warning sign that the whole trend is about to flip.
Which brings us to, well, right now, because if you look closely at the chart, there seems to be this subtle, kind of hidden clue, a divergence that a lot of people might be missing. See, on the surface, everything looks fine and dandy. The VIX price has been falling, which usually tells us, hey, the market's calm, investors are confident.
But if you peel back that top layer and look just a little deeper, one of the key indicators is telling a totally different story. It's a classic mismatch between the price action and the energy that's actually driving it.
All right, so here it is. This is the chart. Up top, you've got the VIX price, and you can see it's been making lower lows. But now, look at the bottom panel. That's a momentum indicator called the True Strength Index, or TSI. And notice anything? It's not making lower lows. It's actually making higher lows. It's going the other way.
So what you're looking at right there is what technical analysts call a bullish divergence. Now that sounds good, right? Bullish? But remember, we're talking about the VIX. So bullish for the VIX is actually bearish for the stock market. It means that even though the price of fear is dropping, the underlying momentum is quietly building, getting ready to push it higher.
And this is the key number to watch, 15.45. For the VIX, that is historically very low. When fear gets this cheap, it's often a sign that the market has gotten way too complacent and, well, that can be a dangerous place to be.
And there's another piece to this puzzle. On the same chart, you can also spot what's called a Bollinger Band squeeze. That just means the price has been trading in a super narrow range. The best way to think about it is like a coiled spring. All that energy, all that volatility is being compressed. And what happens when you compress a spring? Sooner or later, it's going to uncoil. And periods of low volatility are always followed by periods of high volatility.
And really, that's the bottom line here. When you see this kind of bullish divergence in momentum combined with a volatility squeeze like this, it often acts as a really powerful heads-up, a leading indicator that we could be in for a sharp spike in the VIX, which, of course, likely means a drop in the broader market.
Okay, so we've got the signal, we see the warning sign, but what does this actually mean? How do you go from spotting a clue on a chart to thinking about strategy?
Yeah, what is this quiet little divergence trying to scream at us? Well, it really comes down to three key things. First, it's hinting at a hidden shift in sentiment. The market looks calm, but fear might be building under the surface. Second, you can think of it as an early warning flare, a signal that a market downturn could be on the horizon. And third, for traders, this is a huge potential opportunity.
It's a signal to get ready for volatility to expand in a big way.
So what might they do? They might look at strategies that actually make money when volatility goes up. That could mean buying call options on the VIX itself, basically betting that fear is about to spike, or they could buy put options on the SPY, which is a direct bet that the market's going to fall. There are even other strategies, like straddles, that are just designed to profit from a big move, no matter which direction it goes.
So, when you put it all together, yeah, the surface of the market looks pretty calm. But the instruments we use to look beneath that surface are definitely detecting a change in pressure. The fear index is flashing a quiet but classic warning sign. And it really just leaves us with one big question to chew on. Is this the calm before the storm?